The election is done. How can I manage my money effectively now that we know who is in charge of the White House, who is in charge of the Senate, who's in charge of the House, where the governors stand on all these different issues? We're going to break it all down right now in this video. My name is Jeff Sokol. I am in private wealth advisory at GT Investment Management. I work with business owners, entrepreneurs. I work with venture capital from early stage all the way from ideation up until exit planning. Then I help manage that money. I help keep it secure. And that's a big piece of this video as well, is talking about securing your assets. That includes effective tax strategy, estate planning, cash flow analysis, all sorts of different things other than just, I'm not this guy who's going to tell you what to buy, what to sell. I can help you with that. I've got a little bit of a trading desk and hedge fund background. I've got some nice proprietary models to help with stuff like that. But in this video, let's talk about what's going on in the market and how you can make sure you are positioned most effectively. And I don't want to get into any controversial subject matter, but I will just say for the markets, I am wearing my bright red t-shirts in honor of the red sweep. It looks like the market is pricing this in as just about best case scenario, but markets do tend to rally into year end, especially in election years. So let's not get too far ahead of ourselves. Let's not pick sides here. Let's just think about how to effectively manage money. Here we go. Something I want to quickly touch on before we dive in, which is these key considerations in a polarized environment. This is political polarization. It's a multipolar world. This creates vulnerabilities, not just tensions between nations, but some civil hostility, maybe some interpersonal challenges that we face politically as a country that extend out between regions. There's still the conflict in Europe between Russia, Ukraine, and no matter where you stand with what's going on in the Middle East or with China, Russia, or the BRICS nations are going to team up on us. There are vulnerabilities. It doesn't help that we're something like 35 or $36 trillion in debt. There's still a chance that it's a wise idea, or at least a good planning exercise for you to think about having a plan B of sorts. Not to go all in on precious metals here, but okay, let me just go through it. So there's hard assets like precious metals that do tend to protect you against inflation risk or systematic risks with fiat currencies. Let's say you're a business owner and you have all of your assets domiciled in bank accounts here in the United States. You have United States real estate, United States equity. You have a 60-40 stock and bond portfolio, and you have a business here. Well, you're concentrated in the United States. Is it the worst idea to maybe getting a second passport is a bit much, but to be able to know that you and your family are secure to travel to other places, that you have residency established elsewhere. This is this idea of international real estate. Some countries, if you purchase real estate there, you automatically get residency. That allows you to have foreign bank accounts. You can have a foreign business there. And maybe that's not the worst idea in the world. There is also this idea here. I'm thinking about digital security. If your information is at risk of cyber security or data hacks, similarly, having a digital backup as access to assets digitally, like cryptocurrency. You guys probably know if you've watched some other videos, I do feel quite bullish about Bitcoin as an asset class and as an industry, really, like what MicroStrategy is doing. I made a video about them last week. So if you are doing well and you are worried about potential downside risks, these are healthy exercises to embark. We've done this a lot. It's like a consulting assignment, getting to know you, your risk profile, what would make sense for you and your family. And an important thing about this is that it's not like we're going to say that you need to go all in on this crazy alternative strategy. It's just, are there attractive assets that also help you stay more hedged, that manage risk effectively? Like I said here, in a polarized world where there may be certain vulnerabilities, these are some key considerations that go a little bit further outside of just, hey, now there's Republicans in office. What should I do with my stock portfolio? It's like, let's branch that conversation out and think more broadly about what we can do to stay secure in volatile times for now and this generation and beyond. So, just something to think about. And now, let's go for it. I want to show you guys something that is, I'm not going to call it a misconception, but I would say it is a narrow viewpoint, which seems to be the case out there, including on ChatGPT. So let's ask it this question. What sectors are poised to do well in the stock market with a Trump presidency? If Trump were to regain the presidency, we could expect a focus on policies geared toward lower corporate taxes, deregulation, and domestic energy production, similar to his previous administration. So it says energy would do well, financials would do well, industrials and manufacturing, healthcare, technology, materials. There's only 10 sectors in the S&P 500, actually 9. They've basically just put 7 in there, so like everything is going to do well. I mean, they pretty much covered it all. And we'll get back to that in a second. And if you ask if Kamala Harris had won the presidency, the same question. They focus on renewable energy, healthcare is in there again, technology innovation is in there again, education and workforce development, consumer staples, construction materials, electric vehicles. So a lot of crossover, but you see like renewable energy, although if you look at Enphase, their stock at one point was up like to 300 something per share, is now down to like 66. It's just been absolutely killed. Um, Electric vehicles are supposed to do well in a Kamala environment, but Tesla is ripping to the upside because of Elon's relationship to Musk and everything that's going on fundamentally with that company. So you just watch out for this because, and we're going to talk about this more with actual data, charts, and analytics and statistics because it's not so simple. It's not a point A to point B conversation like, oh, Trump's back in. Let's get into the financial sector. What you have to do instead is look at how these assets and these sectors are priced right now relative to their historical averages and what these companies look like both fundamentally and technically on the charts before you just blindly think, okay, this person is in office. I need to buy this company. That is simply too narrow of a view. And as much as I like this research tool, I mean, I like using ChatGPT, and I'm not saying that this is a bad exercise. I just want to say we have to always look more broadly about what is going on in markets before we just think, oh, because this person in office, therefore this asset good. It's like let's not be cavemen here, right? The video and audio in here is a work in progress. The glare was so bad earlier that I just left. I came back at night to try and film it now, but this light over here on this side is so bright it's like turning me into a ghost on this side of my face. But anyway, what was I going to say? So I mentioned that there are 10 sectors in the S&P 500 in the last clip. It's actually 11. I thought about that afterwards. I was like, what am I talking about? And there are subsectors as well. So let's not get hung up on that. Let's just keep diving into more data here. But before we do, where am I bullish? Well, with publicly traded assets, because I'm biased toward alternative asset classes, but if every portfolio should have public exposure. I like energy. I like utilities. There are defensive names that I like. I think if I were building a portfolio, I would look for, well, I sit in a risk chair if I'm putting money to work, especially other people's capital, especially wealthy people, where delta to the downside is more, or protecting against that delta is more important than a compound annual growth rate. So I tend to like energy. I tend to like utilities. I like these energy income funds as well as infrastructure funds. I like master limited partnerships, downstream, midstream, and upstream to do with energy production, manufacturing, logistics. Those are good because I view them as being defensive. I see them as having good risk-adjusted returns, and a lot of them are paying like 6, 7, 8, 9% dividends. So you're getting capital appreciation and some income. What's not to love? But anyway, we can talk more about what I like. Let's go to the data here. Let me get out of the way here. So from Mike Zaccardi. All right, this is important. Looking at the forward 12-month price earnings ratio for the S&P 500, currently 22.2, above the 5-year average of 19.6, and above the 10-year average of 18.1. Okay, bringing this back to political outcomes. First thing people do when they talk about, okay, where should I be invested now that Trump is in office? Well, the first thing you have to consider, look at when Trump took office in 2016. We were below the averages. So the mean reversion was to the upside. Whereas now, mean reversion would be to the downside. This has nothing to do with his policies, which, by the way, it takes like 6 or 12 months to get a bill written and through Congress and all the politics and infighting. I don't care how red that house is or how much MAGA momentum there is, it still takes a long time. There's a huge lead time before you can get something done, and then once it is done and it's executed and implemented, there's a huge lag time before it really makes its way into the economic outputs, into the data, into the actual valuations. So we got to start with broader market dynamics. This is an important thing. And now we can break it down by sectors. I talk about how I'm keen in energy and utilities as an example. So it's the same chart, but now looking at 25-year averages, and you can see some sectors by this ratio or by this comparison, like info technology, consumer discretionary, the tech areas are a little bit more overvalued. And you can see that the S&P 500 here as a whole is more overvalued, whereas to the right, there are sectors that aren't looking as crazy. Healthcare, utilities, financials, and energy. More or less defensive areas. But it's just something to keep in mind if you're feeling like, hey, I've made a lot of money in tech, I want to rotate. Well, it's not the craziest idea in the world. Now, let's just think about this red wave. This is from Ryan Dietrich from Carson Investment Research. Great follow over on Twitter or X. Here's his data. Stocks historically haven't done as well under a red wave. This is data, so you can't argue with it. You can't be disappointed. You can't have a partisan take here. This is just data. Not to say that it's done badly in a red sweep, but this is the data. Average of 6.7%, median of 6%. So up, but not out of this world. We have had some down years, some major down years, including with Bush in 2002. This is after the dot-com bubble and 9/11, so these are contentious times. But yeah, just something to keep in mind. A split. This was from Ryan Dietrich as well, posted by our friend Isabel Nett. They do great research, and they put a good blog out. Just reading directly here. Historically, a split Congress has frequently led to a favorable U.S. stock market performance, as investors often view the reduced policy risk and increased stability of divided government positively. Yeah, when the market is left to its own devices, it does well. This sounds a little bit counterintuitive, but it's a good thing. Markets love stability, they love certainty, but what do they love even more than stability and certainty is knowing that there's so much infighting in the government that they're just going to be left to their own devices. They're not vulnerable to regulatory and legislative risk. They can just go ebb and flow and do what they got to do with real free and fair market price discovery. So that's something interesting to keep in mind. But next best thing in this case is Republican. So there you go. Then here we go. The sectors that worked and didn't work under the last Trump presidency. I feel like this stuff can be misleading. Energy, well, there was COVID, right? I mean, it was just a different world that we were dealing with. So it's hard to say that this is something that could be replicated because I tend to think energy now is undervalued and tech is overvalued. So you might get the exact opposite of this, and it might have nothing to do with Trump. So, this is just one of those things. Lance Roberts, a friend of ours, great money manager. So this is not a knock on him. It's just got to be careful. You have to really dig in. You can't just look at something and be like, oh, energy did badly last time, it's going to do badly again. It's just, like I keep saying, got to make it more broad. But where are financials here? Because we're going to look at financials in a second. So financials did well, maybe not on a relative basis, not as well as some of these other sectors. But look, financials were up, so they'll be up again. Well, sure, in theory, but look at their 1-year returns. This is in the present moment. Berkshire up 32% in a year. JP Morgan up 67%. B of A up 62.5%. Wells Fargo up 73 almost. Goldman Sachs up 83, and their investment banking proceeds are starting to go up as well. So gets you a little bit excited about capital markets. But I mean, when you've gone up as much as these financial names have in a year, how much further upside can there possibly be? Not to say they can't replicate this performance, it just becomes a little bit less likely. It's like if you roll snake eyes You have two dice. You roll a one and a one. It becomes, statistically less likely that you're going to keep rolling that same number over and over again, even though in each individual roll has the same probability. To see something happen twice in a row becomes less likely. So, it's not the most meticulous or data-driven way of looking at it. But anyway, those are a few thoughts. And now let's go on to the next section here. History happens to the president. I don't care how bullish you might be right now. I don't care if you think that this is the best setup for a secular bull market to continue. The data would indicate that something always happens. It's just unavoidable. This is the nature of the universe as we know it. Biden had a 21% drawdown. Trump had one. It was COVID, but that's the point. History happens to the presidents. Like there's nothing they can do about it. Obama had one. Bush had one. Clinton before him. H.W. Bush, W's father, Reagan, Carter, Gerald Ford. The list goes on and on. Hopefully it's not as bad as what we got for Herbert Hoover here after the Great Depression. But at some point, the wheels are going to fall off. Who knows what the reason will be? Will it be war? Will it be inflation? Will it be, who knows? Is it a banking issue? God only knows. But at some point, there will be a problem. And chances are, it's not going to be the president's fault. It's just the way things go. Speaking of history happening to the government, well, here's something that is somewhat historical from the Kobayashi letter. Pro-growth, I was about to say pre-growth, pro-growth fiscal spending percentage. Very low, which means that the fiscal spending is going toward non-productive items. That is not my opinion. I am not deciding what is productive and what is not productive. I mean, paying for interest, Social Security, Medicare benefits, these are liabilities. They do not go on to create GDP, is effectively what I'm saying here. It's not stimulating growth. It is to pay for things. Okay? This is at some point, in theory, like I just said a moment ago, if they want to get a spending bill through, that's going to take time to write. It's going to take time to implement. It's going to take some arguments on the floor. Even if you have a red wave, there's going to be disagreements. There's going to be squabbling. And we got to get something over the finish line. And if we don't, then there will be problems, particularly if we see these earnings consensus estimates start to go down. So this is the fourth quarter. Here we are now, right? This is how you get a rally because markets are forward looking. They see earnings per share increasing. So that means revenues are up, profit margins are up, earnings per share up. If you have that, we're going to keep rallying. What if we don't? What if we have something like this, where from the third quarter 2023, it goes down? And then it starts coming back up. But even just a blip where something gets repriced downward, you're going to have trouble. What if earnings start to fall off and there is a spending bill that has not gone through yet? We could have trouble. At the same time as that, household allocation to stocks hits an all-time high. We haven't been here since COVID, when we flash crashed. And before that, '08, major crash. And before that, dot-com bubble of 2000. I'm not saying it's going to happen again. I'm just pointing to areas or potential areas of confluence that one or two or three or four or five different items could happen all at the same time. It could be unlucky. It could be a black swan, whatever the reason could be. There is a case to be made that there could be something challenging. It, usually does happen. Usually does. If all this sounds a little bit complicated, this is a strategy we recommend. Our friend, Mr. Family Office, great guy. Follow him over on X. He does a newsletter. He's on LinkedIn as well. A great way of doing this, don't just outsource the portfolio. This is something I always talk about. Managing money, I'm not going to call it easy, but on a relative basis, it's much easier to just manage money. The wealth management side versus, I'm just talking about investment strategy, asset allocation, advice. But what about cybersecurity? What about risk management? What about reporting? What about the back office bookkeeping? And then it gets into taxes. Huge part of what I do with my clients. We do tax strategy. We bring their effective rate down. Lifestyle services, sure, by all means. And let's add in some of those sovereign risk ideas that we talked about at the front of this video, right? With passport optionality, maybe some residency, international real estate, um, other things like that. Trust and corporate services, very important as well. I'm not going to get into all of this, but you can just look around and see, hey, don't just have somebody manage your money. Have somebody manage the whole thing. And not just right here and now for the next few days or few weeks or few months, few years, but let's think generations in advance. Your children, your children's children. All right, now back to the topic of the video with policy emphasis. So, post-election 2016, um, these are ranked items. The Russell 2000 small caps, the financial sector, so on and so forth. It goes down. You want to be able to look at where was a policy focus and where was the return. We're not going to be able to go over everything here. I'm just going to give a shout out to Carson Investment Research. You can find Ryan Dietrich on Twitter or X to dig into stuff like this. I'm just letting you know I've dug into this type of research to formulate my opinions, and I think you should too. Again, here, now this is using the same data set or the same set of research to compare Biden and Trump. Tech led under Trump, Biden led or energy led under Biden. And then let's see down here, energy did poorly under Trump, but also there was COVID at the end of that. And the long bond under Biden did poorly with inflation flying in 2021, 2022 under his watch. So it's I'm not going to say it's a crapshoot. I would just say you have to be careful. You can't just assume, oh, Trump's in, it's going to be tech, or oh, Republicans drill baby drill. That's great for energy. Well, actually, look, it was under Biden that energy was up there. So, just more caution. And my favorite piece of caution is everyone loves pointing to the trade war and how Trump is going to lead us into World War III with China because the tariffs, oh, these tariffs are so bad. Well, Jake Wujastic, our buddy over on Twitter, here is JD, one of our preferred Chinese ADRs, JD.com. Trump is elected. JD goes from about $15 or 10, $15, $10 a share, 20 maybe, up to above 100. And Biden is elected, goes from 100 down to 20. We got in around 22, 23, by the way, and we've had a nice year. But Trump's elected again. Are we about to rip? Well, that would be counterintuitive, right? Because apparently Trump's about to start World War III and the tariffs are so terrible. Let's check with Alibaba. Same thing. Here it was, down like 75, 80 bucks a share. Trump gets in, goes up to what? 285, 300. So maybe those tariffs aren't as bad as we think they are. Or maybe it's just the case that the headline risk, they always tell you something that sounds logical in nature, but is just not true the way markets price things in reality. What we've got right here is a prototype of a model portfolio for a high net worth client. This is a spin on the 60-40 portfolio because it's about 60-40, 58-42, but it's not stock and bond. It is traditional asset classes, 58%. Alternative asset classes, 42%. In the alternatives, we have real estate, hedge funds, precious metals, commodities, art and antiques, infrastructure, private debt, fund of funds, or other types of choosing managers in the private space, direct investments into early stage opportunities, venture capital, or could be anything really, whatever deal flow we have that looks good. Private equity. This is a prototype. Obviously, we can tinker with it and we can play around with it. These are sleeves. These are allocation percentages that we can play around with that when we have a client, we can advise them. And let me give you a case study to make this feel a little bit more realistic here. So what do we have here? Let me move this just ever so slightly so you can see. This is hypothetical. I just want to walk you through my process. In red, we have starting value of 6.4 million, blue starting value of 6.4 million, green starting value of 8.4 million, orange starting value of 8.4 million, yellow starting value of 5 million. Now, the point of this exercise was to assume a 15% compound annual growth rate when you work with guys in high net worth sphere. I'm not guaranteeing a 15% result. In this case, we were able to identify preferred returns of something between 16 and 17%. And say we have a 1% management fee on it, we could land at 15%. So I'm I'm not guaranteeing that result. I'm just saying this is the number we came up with. And the point was they wanted to be able to achieve a certain amount of money to afford a certain level of expenses. This became a matter of cash flow analysis. So red, 1.5 million in expense each year. So that's money going out. Blue, 1.2 million of expense going out. Green, 1.5 going out. Orange, 1.2 going out. And then what we did was we played around with the tax rates. 40% tax rate in red, 30% tax rate in blue, 40% tax rate in green, 30% tax rate in orange. What we're doing there is this is probably some complex structuring, or it's instead of having real estate, maybe it's in Bitcoin, for example. So we're getting the growth, but there's never a taxable event. Or it could be about the entities that are structured. An LLC in a different state than California with a lower tax rate. Maybe it's registered, or we elect to be an S corp, and we just disperse less money from the entity to the resident in California, so there's lower tax bracket. There's a lot we can do to play around with it. But what I did with the yellow was we got to a lower tax bracket, but what we did is we brought expenses down. We're only spending $500,000 a year, and we're in a 25% tax bracket because we're being more efficient with optimizing not just the investments we're using, but maybe some of the investments could be in a health savings account or a Roth IRA or another tax advantaged vehicle. Okay, so this brings our effective rate down, not to mention charitable donations or other things we can do to be creative with our tax strategy. Yellow, this is the important thing. Yellow is the only ending value that is greater than the starting value. How did we do that? Well, we spent less money. And this is where we really jump away, not just from the investments, not from the tax strategy, not from the cash flow analysis, but from a whole different realm to being like, well, what makes you happy? What are you about? What's going on in your life? You're getting older, you have all the money in the world. Do you need to be spending more than $100,000 a month to feel happy? Most people won't list being able to spend 125, 130, $150,000 a month as what gets them out of bed in the morning. They want to have meaningful relationships. They want things to be good with their spouse, with their children, with their parents, with their friends and family in the community. And if you can dig in there from a comprehensive financial planning perspective to give them the lifestyle that they want, then yeah, that is the goal. Um, so, this is this like weird interjection into this whole concept of like, how should I be invested for a different political outcome? I'm always tempted to be like, what do we can't start with the portfolio. We got to start with what's going on in your life. What makes you happy? What do you want to be doing? What are your goals? What's going on? What are your values? Once we have a better sense of that, it's easier to make a plan that you feel really good about. Because if we're just saying, I need to make $1 million a year, here is my portfolio. I have 10 million bucks, you need to make $1 million? Okay, I need to make a 10% return. Then it's like, it's such a narrow set of parameters that we're not digging in to really solve the potential issues here. Not to say that there are issues, but just this is the point. You can look at the 6.4 million or the 8.4 million. You can look at the 40%. You can look at the 1.5 expense, the 1.2, the 30%. But starting with a smaller value, by spending less money, we can have an ending value that is greater than the starting value. So it's not about having 10 million versus having 5 million. It's about having everything dialed in and buttoned up so that your strategy works for you and your family. So we're going to get back to the politics and the portfolio in just a second, but it would be a disservice for me to make this video without showing you a real life case study of a slide that I put in to be like, hey, sometimes it's not really all about the numbers. It's about figuring out what we can do to be happy. outside of the numbers. Okay, a few more charts. The S&P 500 in election years versus 2024. The best election year start we've ever had. One of these has gone up higher, um, but we're higher here than even that year was. So are we going to get a breather here? But look at this one. It ripped up and then actually came back down. So let's see. Let's see. The election day till the end of the year, generally pretty good. An average of 1.6% higher, a median of 1.8% higher. Any bad years that really stand out? Obama here, down 10%. Let's hope we don't get that. But Biden, he ripped higher. And Trump, most recently, 4.5% higher. The actual election day, the best we've ever had. Is that right? We've had some down 3.25, down 4.5. Is 2.5 the very best we've ever done? Looks like it. It looks like it. Through end of year, in the last 7 weeks of the year, when the trailing calendar year is up 10%. Okay, so the previous 12 months up 10%. How do we do in the last 7 weeks of the year? We're looking at 33 different reads here, up 29 times, down 4 times, with an average gain of 3.5%. So, reason to suspect that we will go higher to end the year, at least according to the data. And then what happens after that? Well, this is typically how things play out. We have the election, we go higher to end the year. In the first couple weeks of January, when the new president is actually sworn in, we have not a big down move, maybe in the ballpark of like 2, 3, 4, 5% at the worst, but more like a sideways consolidation for, let's say, what is that, from about 75 to 175. So about 3 months, maybe 4 months of consolidation, and then we start ripping higher. So we seem to be on track for that. But going back to our buddy Jake Woojastic here on Twitter, election year breakout. We had one in 2016. Are we getting one again? Looks like it. How much higher can this one go? Hard to say, but this setup looks pretty similar. This ascending wedge pattern, break to the upside, and up we go. And then this consolidation, and up we go again. So we are looking decent. Now, from a secular bull market perspective, this is where you really start to feel like, the eyes start getting big, or the mouth starts watering, because when you have a secular bull market, they tend to last quite a long time. 2020, there was COVID, then 2022 derailed us for a little bit there, but what are we, only a couple years into this? We could go for years and years and years longer. So let's see. Let's see. But if this bull market were to end here, it would be just only a little bit longer than about the year from 2019 through 2020 before we had that COVID washout. And now let's go to not my favorite, one of my favorite assets, and let's just look at something that is so incredibly exciting. I'm not even going to classify it as bullish. I just want to say, wow, we have come a long way, because this is legislation that apparently is being introduced or being considered for Bitcoin as a strategic sovereign wealth fund asset in a strategic reserve capacity. The Secretary shall establish a Bitcoin purchase program which shall purchase not more than 200,000 Bitcoins per year over a 5-year period for a total acquisition of 1 million Bitcoins, which, by the way, there's only 21 million Bitcoins that will ever exist. So that's not an inconsequential amount. All Bitcoin acquired through the Bitcoin purchase program for not less than 20 years. So they're not just going to buy and sell it. It is no sell side pressure. It is almost 5% of all the Bitcoin in the world being purchased and not being sold by who other than the US government at the federal level. While Mario Nafal, he does some stuff on Twitter. I don't know how accurate this is. I think Dennis Porter even corrected him and said some of this needs to be updated. But we looked at the federal level. Here are states that may consider doing something too. Not to mention Apple, not to mention Microsoft, not to mention other countries or other institutions around the world. But wow, he says, I can confirm that in 2025, multiple states will have strategic Bitcoin reserve legislation introduced. Wow. This is not something that's going to happen overnight, and to see it reflected in the actual Bitcoin price may take longer. This is not something we're going to see in moments. But I mean, even as I'm filming this video, Bitcoin is going to $80,000 a coin. So, hey, the future sure looks bright, my friends. And if you have any questions about this, that, or the other, about any asset classes, or about anything to do with you, your business, or your family, and how to feel a sense of freedom, optimism, and security about your future, feel free to get in touch. We would be happy to help. Alrighty, take care.